Now speaking, Ashish Sharan, Vice President, Investor Relations. Marvell's President and CEO Matt Murphy and CFO Willem Meintjes welcomed listeners to the company's first fiscal quarter 2024 earnings call. They reminded investors that certain comments made during the call include forward-looking statements which carry risks and uncertainties that can cause actual results to differ from current expectations. Investors were encouraged to review the cautionary statements and risk factors included in the company's earnings press release, 10-K and 10-Q filings. The call also referred to non-GAAP financial measures, with a reconciliation between GAAP and non-GAAP financial measures available in the Investor Relations section of the website. Murphy then provided comments on the company's performance. Now speaking, Matt Murphy, President and Chief Executive Officer. Marvell's first quarter revenue was $1.322 billion, above the midpoint of guidance, and their second quarter revenue is expected to be $1.33 billion at the midpoint. Marvell has positioned itself to take advantage of the rapid growth in AI infrastructures, with products ranging from PAM4 optics, DCI, and Ethernet switches. They expect AI revenue to double in fiscal 2024 and double again in fiscal 2025, with a CAGR of over 100% for fiscal 2023 to 2025. Their cloud-optimized silicon platform is expected to drive a significant portion of this revenue growth, with design wins expected to exceed the prior $800 million projection as they ramp up production. In the data center end market, cloud revenue is expected to increase over 10% sequentially, while the enterprise on-premise portion is expected to decline, resulting in flat revenue for the overall data center end market in the second quarter. Now speaking, Willem Meintjes, Chief Financial Officer. In the first quarter of fiscal 2024, revenue was $1.322 billion, decreasing 9% year-over-year and 7% sequentially. Data center was the largest end market at 33%, followed by enterprise networking with 27%, carrier infrastructure at 22%, consumer at 11%, and auto industrial at 7%. GAAP gross margin was 42.2%, while non-GAAP was 60%. Operating expenses were $740 million on a GAAP basis and $459 million on a non-GAAP basis. GAAP operating margin was negative 13.8%, while non-GAAP was 25.3%. GAAP loss per diluted share was 20 cents, while non-GAAP income per diluted share was 31 cents. Cash flow from operations was $208 million, including $40 million in payments for previously committed long-term capacity agreements. Inventory at the end of the quarter was $1.03 billion, decreasing $42 million sequentially. Day sales outstanding was 69 days, a decrease of 7 days from the prior quarter. Total debt was $4.68 billion, including a drawdown of $200 million from the revolving line of credit. Gross debt to EBITDA ratio was 2.1 times and net debt to EBITDA ratio was 1.6 times. For the second quarter of fiscal 2024, revenue is forecasted to be in the range of $1.33 billion plus or minus 5%. GAAP gross margin is expected to be between 44.3% to 46.8% and non-GAAP gross margin between 60% to 61%. GAAP operating expenses are projected to be approximately $694 million and non-GAAP $455 million. Other income and expense, including interest on debt, is expected to be $51 million. The non-GAAP tax rate is 7%. Basic weighted average shares outstanding will be 861 million and diluted 865 million. GAAP earnings per share are expected to range from a loss of 16 cents to an income of 5 cents, while non-GAAP income per diluted share is estimated to range from 27 cents, 37 cents. The company is expecting minimal additional payments for capacity for the remainder of fiscal 2024 and beyond. They anticipate inventory corrections to be largely done by the fourth quarter and ship closer to end demand. Cost reduction efforts are in place to improve gross margin and operating expenses with expectations of modest improvement in the third quarter and return to low end of 64% to 66% target range in the fourth quarter. Non-GAAP operating expense is expected to be approximately $430 million in the fourth quarter, normalized 13-week basis, and increase mid to high single digits sequentially in the first quarter of 2025. $500 million of total debt is due in January 2023 and is expected to be paid off using cash balance and free cash flow. Buyback program is expected to resume in the third quarter. Deutsche Bank analyst Ross Seymour inquired, "Could you please explain how customer behavior has changed over the quarter? Are there any indicators that suggest a bottom in the cyclical side or an acceleration in the AI side?" Matt Murphy replied, "Ross, thanks for the question. We saw encouraging revenue growth in Q2, mainly driven by AI, which grew to $200 million last year and is on track to double this year. Our cloud infrastructure non-AI also saw an uptick in Q2 and is expected to grow throughout the year and into 2021. Notably, we do not include storage in our AI numbers as it's difficult to directly correlate to AI systems. This gives us a very clean and exciting AI number. UBS analyst Tim Arcuri inquired, can you provide a frame for revenue growth in the second half of the year, considering enterprise business are still digesting inventory, data center is up due to cloud, and big networking OEMs have record inventories? Can we expect mid-single-digit or better growth in both Q3 and Q4? Matt Murphy replied, in response to the analyst's question, I can provide insight into our second quarter and future growth. We are seeing sequential growth in our data center business, which is being offset by on-prem enterprise weakness that has been an issue in the server market for the past 5 quarters. Looking ahead, we anticipate strong growth in AI, cloud infrastructure, optics, storage, automotive, and 5G wireless. Although storage is still low, it should recover next year. Overall, the second half of this year looks promising, with cloud and AI-driven growth more than offsetting any choppiness in other end markets. UBS analyst Tim Arcuri inquired, can you provide us with a ballpark estimate of the expected growth in 2021? Matt Murphy replied, at this time, we are not providing guidance for the second half of the year. However, we do expect to accelerate our progress from where we stand today. Bank of America Merrill Lynch analyst Vivek Arya inquired, Matt, could you please explain what is included in AI for this year, and how the $400 million sales figure is broken down? Also, which components of AI are expected to double next year? Matt Murphy replied, the question was about our growth this year and the outlook for next year. We are seeing a strong ramp-up of 800G PAM4 optics, PAM4 DSP, and DCI stuff driving AI traffic in regional data centers. This will continue into next year and then we will layer in cloud-optimized ramps as well. Our wins from a few years ago at the 2021 Analyst Day have taken 18 to 24 months to develop and are now ready to ramp, so timing looks good for next year. Bank of America Merrill Lynch analyst Vivek Arya inquired, Matt, is the $200 million budget for cloud-optimized services allocated for this year? What is the budget for next year? Matt Murphy replied, I can confirm that our current tracking indicates we are on track to hit the $200 million target in this fiscal year. Looking ahead, due to the dynamic nature of the market, we are not providing a specific revenue estimate for next year. What I can tell you is that, based on our analysis, peak revenue is expected to exceed the $800 million figure we projected at our 2021 Analyst Day. This increase is driven by an increase in total lifetime volume and a shift toward AI product designs. All signs point to a good outlook this year and beyond, however, it's too early to call any specific number. BMO Capital Markets analyst Ambrish Srivastava inquired, Willem, what are the assumptions for fourth quarter gross margin and how much of it is based on top-end recovery? Willem Meintjes replied, thanks for the question, Ambrish. We're confident that we'll reach the bottom of our range in Q4. Contributing to this are strong wireless carrier performance and storage recovery continuing through Q4, as well as an uptick in optical product and AI sales. Additionally, internal cost reduction initiatives and supply chain work will have a significant effect on our Q4 P&L. BMO Capital Markets analyst Ambrish Srivastava inquired, can you confirm that excess inventory will remain largely in the networking segment headed into the end of the year? Matt Murphy replied, I would summarize by saying, cloud growth is up 10% sequentially, which is positive. AI growth is particularly strong, while traditional infrastructure growth is also up but still needs to clear some inventory overhang. We are taking action to reduce enterprise inventory in Q2 and wireless 5G is up 25% sequentially. This supports Willem's point that when product lines return to normal we should see a tailwind for gross margins, on top of our own cost reduction programs. Barclays analyst Blaine Curtis inquired, Matt, can you explain the shift from 20% to 50% lifetime revenue and how this plays out over the last quarter? Matt Murphy replied, yes, Blaine. Our initial design wins that we projected at the October 2021 Investor Day were for $400 million, $800 million, with 20% of the lifetime revenue going to AI and 80% to traditional cloud infrastructure. Since then, we have seen a significant increase in our AI potential as well as an expansion of our design win funnel, particularly from the cloud. This indicates a very optimistic outlook for our AI capabilities over the next 5 to 7 years. Barclays analyst Blaine Curtis inquired, could you explain what has changed in terms of your expectations for the India rollout? Matt Murphy replied, "Yes, Blaine, our 5G story has been strong over the last 3 years. We exceeded our $600 million goal in Q4 and have stepped up 25% sequentially since then. India is a factor in this growth and we expect to have 3 strong quarters before a drop-off in Q4. Our performance has outperformed the telecom market." Stifel Financial Corporation analyst Tore Svanberg inquired, "Matt, how big do you anticipate the storage business to be in AI over the next few years?" Matt Murphy replied, "Tore, you bring up a very good point. Our existing product lines primarily focus on hard disk drive controllers, preamplifiers, and flash controllers. However, we are seeing a strong demand for CXL and large systems due to the need to dramatically scale DRAM and memory. We are making progress on this solution and anticipate it driving another segment for us. Additionally, AECs is another product category we've invested in that has been getting strong traction. These solutions leverage our core DSP and analog mixed signal capability, and we are striving to be a broad-based supplier for our customers, whether it's CXL, ACs, PAM4 DSP, optics, or DCI. We also have custom silicon available with exciting opportunities." Evercore IC analyst CJ Muse inquired, "What are the expected ramp-ups for data center and consumer storage in the second half of the year?" Matt Murphy replied, "In Q1, our data center segment bottomed out and is expected to gradually improve in the rest of the year. We don't anticipate it returning to pre-pandemic levels until the fourth quarter, but we are expecting around 75 to 80% of that level by then." On the consumer side, while it has outperformed expectations, it is not a major strategic focus for us and we anticipate a decline starting in the second half and continuing into next year. Should any bluebirds come our way, that would be great, but we are not counting on it. BNP Paribas analyst Karl Ackerman inquired, "How much of your data center business outlook is due to the opportunity created by a competitor exiting their networking ASIC division, allowing Innovium to gain more market share?" Matt Murphy replied, "In response to the repositioning of a competitor, I would say that we are aware of this shift and that it likely has not had much impact on our traditional cloud infrastructure portfolio. We have seen strong growth in this area, which includes our switching platforms. Our investment in the Innovium product line and the addition of a new general manager reporting directly to me for our higher layer networking technology, combined with our optics offerings, positions us to capitalize on the growing demand for high-performance solutions. We don't anticipate any real impact from our competitors' exit from the market and believe there is a large opportunity for those who provide the right technologies." BNP Paribas analyst Karl Ackerman inquired, "Could you discuss the competitive dynamics of AI and how it affects your long-term revenue trajectory?" Matt Murphy replied, "Our expanded design wins, along with our strong US-based presence, IP portfolio, and ability to invest in bleeding-edge technology roadmaps make us a leader in the AI space. We are one of the few companies that can compete at the highest level for chip design and manufacturing. This positions us well to capitalize on the growth of the AI industry long-term." JP Morgan Chase & Company analyst Harlan Sur inquired, "Can you provide an update on the performance of your 51.2T Teralynx 10 switching chipset? Have samples been sent to customers and what progress has been made on the 3nm IP libraries and design wins?" Matt Murphy replied, "Yes, great questions. We have product in hand for our TL10 or Teralynx 10 and the demand is high. On 3nm, we're competitively positioned with other leading-edge technologies. Customers are weighing cost, power, performance, timing and schedule before making decisions. 5nm will remain a steady workhorse technology for a long time. We're in active conversations across our major end markets for 3nm. Cohen and Company analyst Matt Ramsey inquired, "Can you provide some insight into the sustainability of the consumer SSD market given the uncertainty in the pace of China's recovery and the return of enterprise spending? What is your long-term view on investing in the business given the recent design wins and belt-tightening measures?" Matt Murphy replied, "Totally. On the first one, our consumer storage business has evolved to limited product designs that are customized. The first half of this year we were down in Q1 but it's going back up in Q2. We expect it to be down in the second half and will continue to decline in line with our Investor Day model. On the OpEx front, due to changes in market dynamics, customer plans and macroeconomy since our annual strategic plan in August/September last year, we conducted an extensive review of all programs in flight. We've made decisions to exit some programs, allocate more R&D to key areas with surge in demand, right-size certain product groups, and improved efficiency by combining processor and custom ASIC teams. We're confident in our OpEx profile exiting the year, set up for strong drop-through to the bottom line in 2021. Raymond James analyst Srini Pajuri inquired, Matt, what are your thoughts on the growth potential of your enterprise networking business and carrier segments as we enter 2021 with 5G now widely available? Matt Murphy replied, our enterprise business has exceeded expectations since our investor day in 2021 due to increased market share, content gains and new custom ASICs. It is likely to correct in Q2, but should remain relatively flat for the year. In terms of carrier, 5G deployments are robust globally with India coming online this year and other regions next year. However, we expect the market side to move down in Q4 and still not be a major growth driver into 2025. In Wired, telecom will remain weak for some time. Matt Murphy replied, thank you all for your questions. It's been a productive call and we appreciate everyone's participation. We've answered as many questions as we can in the time available and I'm looking forward to any follow-up discussions. Thank you again for your engagement.